Good afternoon. It's a pleasure for me to address this year's Community Banking Research Conference. Let me begin, if I may, by commending the organizers for once again bringing community bankers, researchers, and policymakers together in what I believe is a one-of-a-kind venue that the FDIC is proud to co-sponsor along with the Federal Reserve and the Conference of State Bank Supervisors. This year, we are celebrating the 90th anniversary of the establishment of the FDIC. This Community Banking Research Conference is an example of the important role that research has played at the FDIC since the agency was created by the Banking Act of 1933. In fact, in the FDIC's first full year of operation in 1934, the FDIC board established the Division of Research and Statistics. During that first year of operation, and amid extraordinary banking stress during the Depression, the division developed data on the condition of 93% of licensed commercial banks in the United States, conducted a study of depositor losses from 1865 to 1934, and analyzed efforts to stabilize the banking system at the time. 90 years later, the FDIC remains similarly reliant on and committed to high-quality bank data, analysis, and research to inform our important work of maintaining the stability of the banking system and the financial sector. Conferences like this one, in my view, play an important role in advancing these research efforts and stimulating discussion on important policy issues. I am very pleased to see that the papers in this conference tackle important issues for today's community banks, from interest rate risk and depositor runs to the effects of extreme weather events and the assessment of credit risk. Now, as I am sure this audience is aware, on March 10th of this year, Silicon Valley Bank of Santa Clara, California, with $209 billion in assets at the end of last year, and a 90% reliance on uninsured deposits, was closed by the California Department of Financial Protection and Innovation, which then appointed the FDIC as receiver for the failed bank. The failure of SVB, as it's called, combined with an announcement by Silvergate Bank 2 days earlier that it would wind down operations and voluntarily liquidate, signaled the possibility of a contagion effect on other banks at that time. Consistent with contagion concerns, on Sunday, March 12th of this year, just 2 days after the failure of SVB, another institution, Signature Bank of New York, with $110 billion in assets at year-end 2022, and also a nearly 90% reliance on uninsured deposits, was closed by the New York State Department of Financial Services, which also then appointed the FDIC as receiver. Amid signs of stress at other institutions, concerns grew about further contagion and economic spillovers. After careful analysis and deliberation, the boards of the FDIC and the Federal Reserve voted unanimously to recommend, and the Treasury Secretary, in consultation with the President, determined that the FDIC could use emergency systemic risk authorities that are available under the Federal Deposit Insurance Act to fully protect all depositors, including uninsured depositors, in the resolution of SVB and Signature Bank. Less than 2 months later, as you know, on May 1 of this year, First Republic Bank of San Francisco, California, was also closed by the California Department of Financial Protection and Innovation, which then appointed the FDIC as receiver. At year-end 2022, First Republic held $213 billion in assets, and it had a nearly 70% reliance, pardon me, on uninsured deposits. Unlike Silicon Valley Bank and Signature Bank, First Republic was resolved via a purchase and assumption agreement by J.P. Morgan Chase Bank of Columbus, Ohio, which assumed all of the failed bank's deposits and substantially all of its assets. Since this was a least cost bid, there was no need in this instance to consider a systemic risk exception. Now, community banks, despite all of this, have proven to be quite resilient during this recent period of stress. The initial performance reports from less than a month after the March failures showed that community banks' net income declined by 4.2% in the first quarter of 2023 relative to the previous quarter, as reductions in net interest income and non-interest income were higher than decreases in provision expense and non-interest expense. Even with that decline, first quarter community bank net income exceeded the prior year quarter. At the end of the second quarter, community banks reported an increase in net income of 3.4% from the prior quarter, as higher non-interest income and lower losses on the sale of securities more than offset lower net interest income and higher net non-interest expense. Community bank net income was again improved relative to a year prior. Also, during the second quarter, community bank loan growth continued and was broad-based across most portfolio categories. Deposits held fairly steady, even as larger banks experienced deposit outflows, and asset quality metrics for community banks remained generally favorable. Now, despite this generally strong performance of community banks, it is important to recognize that significant downside risks remain. The net interest margin at community banks fell 10 basis points from the first quarter to 3.39%, as increases in funding costs continue to outpace increases in loan yields. Compared to the industry as a whole, in the second quarter of this year, community banks continued to report a higher proportion of assets with maturities longer than 3 years. Concentrations of such long maturity assets have held back asset yields and given rise to unrealized losses. And in regard to credit quality, the significant upward movement in interest rates and shifts in work patterns has created challenges for commercial real estate, as I'm sure you're well aware, most notably in office properties. The high interest rate environment that still persists and the uncertain economic outlook underscore the need for vigilance and careful risk management as we move forward. Now, in this regard, the bank failures earlier this spring were a reminder that potential vulnerabilities can quickly materialize and become very real. They have highlighted a number of important policy issues that, in our view, need to be addressed. Let me talk about a few of them. I believe an important lesson of this experience relates to the role of uninsured deposits in the banking system. As I mentioned, Silicon Valley Bank, Signature Bank, and First Republic Bank were primarily funded by uninsured deposits, which made them more susceptible to bank runs. It is important for us to re-examine the stability of uninsured deposits in the wake of these bank failures and the role that regulation and supervision may play in mitigating those liquidity risks. The speed with which depositors withdrew funds at the failed banks also merits consideration, as well as we consider our role in promoting financial stability with today's technology. On March 9th of this year, the day preceding the failure of Silicon Valley Bank, depositors at SVB withdrew $42 billion in one day. Not only that, $100 billion were scheduled to be withdrawn the next day if the bank had not been closed. Signature Bank lost 20% of its deposits on March 10th in the aftermath of the failure of Silicon Valley Bank, heading into the weekend in which Signature failed. The ease with which depositors can run and the ability of social media to amplify panic pose significant challenges to regulators in their ability to respond to bank runs. Now, another common vulnerability in the failed banks, as I'm sure you're aware, was the maturity mismatch of assets on their balance sheets and exposure to interest rate risk. As the federal funds rate increased from near zero at the beginning of 2022 to more than 400 basis points by the end of last year, long-term securities held on bank balance sheets declined in value. That decline in value was accounted for on their balance sheets as unrealized losses. But for these three failed banks and for most others, unrealized losses as of today do not affect regulatory capital. Although interest rate risk is not new, the failures have highlighted critical questions about how banks are currently managing their interest rate risk. It also raises questions about the appropriate treatment of unrealized losses for capital purposes. And you should know that the newly proposed Basel III capital rule would begin to address this issue by requiring that unrealized losses on the balance sheet of banks with assets over $100 billion be recognized in the capital of the institutions. Now, Silicon Valley Bank, Signature Bank, and First Republic also grew their assets rapidly in the years before failure. Rapid bank growth is often a signal of risk-taking, and the failures of these institutions merit a re-examination of the connection between asset growth and risk. In addition to these topics, the bank failures in the spring of this year have generated significant interest in the appropriateness of the current design of the deposit insurance system in today's environment. In response to this, on May 1, the FDIC released a report entitled Options for Deposit Insurance Reform. If I may, I encourage you to go to our website and read it if you have not already had a chance to do so. I'm going to spend most of my remaining time today discussing this issue of deposit insurance and the findings of our report. Now, in the report, Options for Deposit Insurance Reform, we make an effort to place the events of the spring of this year in the context of the history, evolution, and purpose of deposit insurance since the FDIC was created in 1933. The report discusses three options to reform the deposit insurance system, as well as tools that may complement possible reforms. The primary objectives of deposit insurance, as I'm sure you are aware, are to promote financial stability and to protect depositors from loss. The business of banking, which accepts deposits that are available on demand while making long-term loans, remains susceptible to runs. Deposit insurance provides assurance to depositors that they'll have access to their insured funds if a bank fails, thereby reducing the risk of bank runs. As of December 2022, more than 99% of deposit accounts in the United States were under the $250,000 deposit insurance limit. The report highlights, however, that while the overwhelming majority of deposit accounts remain below the deposit insurance limit, growth in uninsured deposits has increased the exposure of the banking system to bank runs. At its peak in 2021, uninsured deposits accounted for nearly 47% of U.S. domestic deposits. That's higher than at any time since 1949. Although they account for less than 1% of all deposit accounts. 47% of all deposits, but only 1% of deposit accounts. Uninsured deposits are thus held in a small share of accounts, but can be a very large proportion of banks' funding, particularly among the largest banks by asset size. Large concentrations of uninsured deposits increase the potential for bank runs, and as we know, can be a threat to financial stability. Now, while deposit insurance can promote financial stability by reducing depositors' incentives to run, it can also increase moral hazard by providing an incentive for banks to take on greater risk. Banks practicing sound risk management incorporate the risks associated with deposit withdrawals into their decision-making. Before discussing changes to the deposit insurance system, the report importantly highlights, and I really underscore this, that the effectiveness of deposit insurance depends on how it interacts with other aspects of the bank regulatory system. Regulation and supervision play an important role in supporting the financial stability objective of deposit insurance and limiting risk-taking that can result from moral hazard. Capital and liquidity requirements, as well as supervision of such things as interest rate risk management, rapid asset and liability growth, and concentrations of uninsured deposits are important examples. The report also discusses new tools that might be considered to complement deposit insurance system reforms, such as a requirement that banks maintain an amount of long-term debt to absorb losses ahead of uninsured deposits. The report evaluates three options to reform the deposit insurance system. First, maintaining the current structure of limited coverage, including the possibility of an increased but clearly delineated deposit insurance limit. Second, unlimited coverage of all deposits. And third, targeted coverage, which would allow for higher or unlimited coverage for business payment accounts. Of these three options, the report identifies targeted coverage as having the greatest potential for meeting the core objectives of deposit insurance relative to its cost. Business payment accounts may pose a lower risk of moral hazard because those account holders are less likely to view their deposits using a risk-return trade-off than a depositor using the account for savings and investment purposes. At the same time, business payment accounts may pose greater financial stability concerns than other accounts, given that the inability to access these accounts can result in broader economic effects from the failure to make payrolls that might be mitigated by higher deposit insurance coverage. The report points out that providing a practical definition of ensuring that banks and depositors cannot circumvent definitions to obtain higher coverage are important to the effective implementation of targeted coverage. So, in conclusion, if I may, I'd like to thank the Federal Reserve Bank of St. Louis and their outstanding administrative and technical teams for hosting this conference. I also want to thank the conference organizing committee led by Jim Fuchs of St. Louis, with members from the Federal Reserve System, the Conference of State Bank Supervisors, and the FDIC for the outstanding conference agenda. Additionally, I'd like to thank the presenters, discussants, and panelists whose research and insights are the reason this conference occupies an important place in the field of banking research. The events of this spring raised a number of important and challenging policy issues. The existing body of bank research has already been influential in shaping the analysis and thinking on these issues. Yet, as you know, there remain many open questions to address. I would like to take this opportunity to encourage all of you to continue working to inform our understanding of these issues and their impact on community banks, the banking system as a whole, and on banking regulation. That's my story for today. Thank you very much for your attention.